All right, so again, we're learning about capital budgeting in this chapter. So this could be both making investments where you're buying another company, you're embarking on some project, you're buying some equipment. Anytime you're taking some of your capital, some of the investment resources you have, and using them to try to grow the company. That becomes a capital budgeting decision. We had a chapter on budgeting, right? Right? Okay, so we've talked about capital budgeting. But we're gonna get into more detail on how do you decide if you do option A or option B when it comes to your capital budgeting decisions. Okay. The little gremlin that likes to turn off my remote seems to be hard at work. Put new batteries in this and everything, so I don't know. It keeps acting up on me. All right, so there aren't that many concepts how to make these capital investment decisions. A couple ways we could do it that are fairly simple are the payback method and the accounting rate of return. So we'll cover those first. Again, they're pretty simple. They are very easy calculations that you can use to get a rough idea on how quickly an investment is going to pay itself back, or how quick, or how much that investment is going to earn you in terms of return. But there are much more sophisticated approaches we can use as well. Things like net present value, internal rate of return. These factor in something called the time value of money, which is right here, time value of money. Who can tell me what that is? What is the time value of money? If I offer you $100 today or $200 next year, which is better? Maybe. $100 today is not bad. You never know. What if I'm not around next year? You don't get the 200, right? Or what if you could take that 100 today and go buy a lottery ticket and then you're a billionaire, right? There's a $1 billion lottery out there. So how do you make that decision? Well, you could factor in all kinds of different considerations, but one would be the time value of money. How much growth can you realistically expect if you invested that $100 today? You put it into, let's say, a CD in the bank, maybe you get 5%. So it grows from 100 to 105. You're better off waiting and getting the 200, right? But if there were another investment out there where you could double your money, then you might as well take the money today, double it, and you get the 200. You don't have to wait. So that's what the time value of money is. Comparing the potential growth of an investment over different periods of time. And it gets very complicated. But fortunately, we've got some tools we can use that make it pretty simple. So we'll learn how to use those tools, and it will involve some spreadsheet work. So if you have Excel, super handy. Excel is a great spreadsheet program. If you don't, for this chapter, you will want to use a spreadsheet. You could use Google Sheets, which is free. You could use Numbers, I think is the Apple spreadsheet program, or any other spreadsheet that you can find. Okay, but I'm going to show you how to use Google Sheets, and I'll show you how to use Excel as well to solve some of these problems. How many people are familiar, have actually used spreadsheets before? Okay, and how many have used spreadsheets for functions where it's got a formula and it calculates for you? Okay, so that's basically what we're going to be learning to do. So if you're already familiar with that, great. You'll find this chapter, it's probably not going to be so hard. Now, this time value of money involves the present value and the future value of money. So you could take a future value, like the $200 I didn't really promise to give you, but hypothetically said, if I gave you $200 in the future, right, you could figure out what would that be worth today, assuming I could invest it today. Or you could take that $100 today and say, if I invested at a certain rate, what would that grow to in a year? So you can figure out the future value or the present value. So we'll learn how to do that. And we'll learn how to do that with lump sums of money, like in the example I just gave you, $100 today is just one amount of money. But what if I were offering you $10 a month? Then it gets a little more complicated to calculate, well, then how much is that going to grow if I'm investing it? So I'll teach you how to do that as well. When it's a regular amount of money that you're either getting or paying, but it's happening on a regular basis, in this chapter we call that an annuity. Alex, in the real world, if you say annuity to pretty much anybody, and if they have any idea what it means, they'll probably be thinking that you're talking about a life insurance annuity, where you deposit a certain amount of money, and then you get it paid back to you over time, which can be great investments for some people, but that's only the most common understanding of what an annuity is. In our accounting chapter, it could be where you're getting money on a regular basis, but it could also be where you're putting money in on a regular basis. So we'll learn how to calculate those. We'll learn what are called discounted cash flow models. That's how you take a future value and you discount it back to what the present value would be. And we'll compare the time value of money approaches, like internal rate of return and net present value. We'll compare those with the easier ones I told you about, the payback method and the accounting rate of return, that do not factor in the time value of money. So that's what we are covering this week. Okay, questions or comments? Janelle. Either Excel or Google Sheets, some spreadsheet program. There are going to be some problems where that's the only way you can solve it. When we get to internal rate of return, I don't know how to solve it. I have no idea. It's so complicated that we just use a spreadsheet, and the spreadsheet does the hard work. Everything else, other than the internal rate of return, you could do without a spreadsheet, but it's just easier using the spreadsheets. So we'll be doing a lot of spreadsheet work. All right. So capital investments, I already talked about what that is. You're investing in something, right? Even buying equipment, buying a building, you're investing in your own company, right? That's still a capital expense. If you're expanding into new products or expanding your company into new markets, that takes a lot of money, right? That's also a capital investment because you're investing money to try to grow your company. So all of that would fall under this umbrella of capital investments. As opposed to operating expenses, those are just the costs of keeping your current business going. Okay? So capital investments really have to do with growing the company. Operating expenses are just keeping things going. Now, in making your decisions, should I invest my money this way, maybe building a new factory, or should I invest my money into making a new product? How do you make that decision? Well, the first thing you want to do is screen out any decisions that don't meet your criteria. So as a company, you might decide that you don't want to do any investments that cost more than $50 million, or you don't want to do any investments that don't give you at least a 6% return. So you've set certain standards for your investments, and anything that is not going to meet that standard, well, you just don't even consider it, right? So you just do the calculations, and say, does it even meet our minimum requirements? If no, forget it. Kind of like the same way recruiters, when they're looking at people's resumes, they'll go through them and just say, okay, this person, is a maybe, this person's a no, this person's a maybe, this person's a no. They're screening out the ones that are definitely not a fit. And then they go back through the maybes to take a closer look. And that's what we're doing here. We're saying you screen out any possible investments that are definitely a no, because they don't meet the criteria. And then the ones that are maybes, you think about what's our preference. If we boiled it down to two different options that both meet the minimum requirements, then we say, okay, which of these two would we prefer? Or could we do them both, right? But if you can't do them both, then you say, okay, well, this one's a little riskier, but this one we won't make as much money. So then it becomes a preference. And you make your decision. Make sense? Okay. All right, the payback and accounting rate of return. So these are the two methods that you might use to analyze your options. But again, these do not involve the time value of money. They're just quick, simple little calculations you could do. Payback method. You take the amount that you need to invest, you divide it by the net annual cash flow. In other words, if this investment we think is going to generate X number of additional dollars of cash every year, we take that X number of dollars, divide it into how much we're investing, and it tells us how many years that's going to take to pay itself back. Very simple calculation. As it says here, to calculate your net annual cash flows, you're just saying how much cash is this investment going to bring in minus how much cash is it going to cost us. Pretty simple. Here's an example. If our investment costs $150,000, that's an upfront investment. Doesn't matter if we finance it or pay cash, doesn't matter. Just that's what it's costing us, right? And it's going to generate $20,000 of net cash flow per year. We just divide and we see, well, it's going to pay itself back in 7.5 years. This does not factor in inflation, does not factor in how we could invest that money if we didn't invest in this particular project or whatever it is. It's just a simple calculation to get a rough idea of how quickly this investment will pay itself back. And again, this net annual cash flows is just how much cash we think it's going to bring in minus how much cash we think it's going to cost us per year. Any questions on the payback method? Now, your cash flow is not always that even, where it's the same amount every year. So if it's not even, you're going to have to do something like this, where you say, okay, at the very beginning, we have to invest some money, right? So in this example, there's a $40,000 upfront investment. So that's money going out. Then in the first year, we think that it's going to generate $10,000 of net cash flow. So if we invested 40 and we subtract the 10,000 we get in the first year, we only need 30,000 more to break even. And then in the next year, we're expecting another $10,000 of net cash flows. Now we only need 20 grand. Next year, 5, so we're down to 15. Another 5, we're down to 10. 7,500 in year 5. Now we need $2,500 more to get to that break-even point. But then what you do is you take 2,500, that's how much you still need to recoup, right? To cover your initial investment. You divide it by the next year's expected net cash flow. And that gives you a fraction of a year. So in other words, it's going to take 5.33 years to reach our break-even point, where the investment paid itself back. Okay, so you'll use a table like this. Again, the very last step is what it shows here. How much is still remaining to get to that payback period, divided by the net cash flow for that next period. That gives you the partial year. Or 2,500 divided by 7,500 gives you the partial year. God bless you. It says in this case, the company has where is it? God bless you. Okay, there's a question down here. Would the company accept this investment based on payback? Somewhere, I don't remember where it is, but somewhere it gives a, oh, here it is. The company expects a payback period of 6 years. So in other words, that's part of their screening. They're not going to accept any investment that does not pay itself back within 6 years. So after they do this calculation and they see it's 5.33 years, would that be acceptable? It's less than 6. So yeah, if it were anything above 6, then no, they would not accept it. So any questions on how to calculate your payback period when your cash flow is uneven? Again, you pretty much want to use a table like this. We will see, I think there's an exercise that we're going to do later where you could really just do it on your, by counting on your fingers. But if it's too complex, or you can't just do it in your head or on your fingers, then you're going to have to use a table like this. Oh, in fact, is this it? Is this the one I was thinking of? Yeah, it is. Okay. There we go. So let's just do this exercise together. This investment costs $120,000. It says we'll make $30,000 of cash flow in year 1. Right? Is this cash flow? Expect, it says a return. Okay. That's what they mean. They're talking about the cash flow. So in year 1, we get $30,000. Let's just see how many years it's going to take us to get up to the $120,000 investment. So 30,000 in year 1 plus 20,000 in year 2. So now we're up to 50,000, right? Okay. And then in year 3, it's another 20,000. So now we're up to 70,000. In years 4 and 5, it's 15,000 each. So year 4 brings us up to 85,000. Year 5 brings us up to 100,000, right? I'm just adding. Year 6 brings us up to 110. Year 7 gets us up to 120. This one was simple enough. We don't even need the table. It would take 7 years for us to generate enough net cash flow to get up to the $120,000 original investment. So we can see the payback period here for exercise 5 is 7 years. So that's our answer. 7 years. You could do the table, right? Start. How would we do it? What would the table look like? What would be for year 0? The $120,000 initial cost. And then we would just subtract from that, right? We would subtract 30,000 in year 1. That brings us down to 90. 20,000 in year 2 brings us down to 70,000. Another 20 in year 3 brings us down to 50, and so on until we got down to 0. Because then we completely recouped that investment. And again, it would be 7 years on the dot. And if it wasn't 7 years on the dot, for the last year, we take whatever we still need to get to that payback point, divide it by how much we expect in net cash flow for the next year to get the fraction of a year. Okay. Any questions on that process? Okay, so okay, so you're an accountant, you're considering two project investments. One has a 3-year payback period, one has a 5.5-year payback period. Okay. The company requires a payback period of no more than 5 years. Well, I think we just screened out one of those options, right? The 5.5-year investment, not going to work for us. Doesn't meet our requirement. So what's left? The 3 years, right? But maybe that 5.5-year investment was a really good opportunity. So let's say we decided to make an exception, we'll consider it. We'll let this one squeak through. But now we need to compare these two options, the 3-year or the 5.5-year. What other factors might we think about in deciding which of these two options to pursue? Let's say you've got two job offers. One that pays $60,000 a year, one that pays $30,000 a year. Pretty big difference in salaries, right? But is salary the only consideration? So what else? Let's stick with this this job opportunity scenario. What else would you think about? Opportunity to move up?
Benefits.
Benefits?
Mission.
Company's mission. I like it. What else?
Schedule.
That
Schedule.
the schedule, the location, the culture.
Work environment.
What's that?
The work environment.
The work environment, right? These are all factors you would consider. Now, if you're a company trying to decide between two different investment opportunities here, two different projects, you could do it. Yes, there's the payback period. There's the upfront cost. There's the potential profits. The possibility it might lead to other opportunities if you take one particular path compared to the other. The risk involved. Are there insurance requirements? Do you need additional staff? Do you have expertise in this area? Problems that might arise. So there's a lot to consider, right? But the payback period, that might be enough to just screen out a decision in some cases. All right, so now we get to accounting rate of return. The payback period gave us an answer, which was the number of years, right? How many years we expect before this investment pays itself back. This gives us a percentage. This tells us how much of a return we can get. But it's an accounting rate of return. Because we've got different returns. We've got return on investment. We've got internal rate of return that we're going to get to later in this chapter. This is the accounting rate of return. Now, the way you calculate it does involve the initial investment. In this case, the initial investment is on the bottom of the calculation, not on the top, right? Because in the payback period, the investment was the numerator, right? And net cash flow was the denominator. Well, here, the denominator is the initial investment. And the numerator is basically the extra revenue that you're going to earn minus the extra costs. So in other words, how much extra profit are you expecting to earn? Where the payback period used cash flow, here we're using profit. It refers to it as incremental. That means basically just extra. So what are the incremental revenues minus the incremental expenses? Or you could just look at it as the incremental profit.
Does incremental mean the same as like marginal, where it's the same with each one you add? Like in this case,
Marginal where it's the same what?
like marginal, I think that was from my comment, but when something decreases, like for like the amount that it decreases every year. Know what that means?
Not necessarily. I'm not an economics instructor. I taught economics once and I hated it and I did a terrible job. So I'm not going to pretend that I know what marginal means in an economics class, but I can tell you what incremental means. It just means by doing this project, how much extra revenue are we going to earn minus how much extra expenses. But if you find the answer to that, feel free to let me know.
The next slide has two examples, one for each.
Yeah. Yeah. So it's basically how much additional profit are we going to earn divided by the investment, right? And it'll give us a percentage. Oh, we have already an exercise. Okay. Didn't we just do that one?
No, that's okay.
Oh, okay. So this one costs $300,000. The incremental revenues are $200,000 per year. The incremental expenses are $125,000. Okay, so what is our incremental profit in this case? How much extra profit can we expect per year based on this information? 75? And we said 75? Okay, yeah, it's the extra or incremental revenue minus the incremental expenses. The difference is 75,000. We just divide that by the $300,000 cost. 75,000 divided by 300,000 comes out to 25% or 0.25, right? And so our accounting rate of return in this example is 25%. Pretty simple. So we just take the incremental revenues minus the incremental expenses divided by the investment. Any questions on that? All right, let's see, this printing company is considering buying a printer that costs $60,000. So that is the initial investment, right? They expect a 15% rate of return on this investment. So that is their requirement. It has to give them at least a 15% accounting rate of return. The incremental revenues they anticipate are 30,000, right? That goes there. Incremental expenses are 15,000, that goes there. So we take the 30,000 incremental revenue, subtract the 15,000 incremental expense. What is our incremental profit then? $15,000. We divide that by the 60,000 initial investment. Again, it comes out to 0.25, coincidentally. So our accounting rate of return is 25%. If we require a minimum of 15%, then this would be an acceptable return, right? Because it's more than 15%. So again, ARR, payback period are both fairly simple. Okay, in this case, we're going to use both. We're going to use ARR. It's hard to say that and not sound like a pirate. ARR and payback period. Now, we know by now that cash flow and profits are not the same thing, right? We've gone over that many times. In this case, they do happen to be the same, just I think for simplicity's sake. And it is kind of interesting to see the relationship between these two calculations if your cash flow does equal your profits. So let's go ahead and see what it comes out to. What would be if our cost of our investment is $240,000 and the incremental revenue is $200,000, incremental expense is $140,000. what would be our ARR in this case? $125 again. Okay. They weren't very creative when they made this chapter. It would be, right? Because 200,000 minus 140,000 gives us 60,000 incremental profit. Divide by the 240,000 investment, you get 0.25. So 25% ARR. Let's calculate. Oh, go ahead, Jordan.
Is the incremental profit always the same as the cash flow, or is it just like that for this one?
It's just like that for this one. Yeah. So it's, yeah. In other cases, it's usually going to be different. And so let's do the payback period. In this case, we've got initial investment, again, 240,000. Our net annual cash flow, it says, is 60,000. So what's our payback period?
4 years.
4 years. Okay, so you can see the relationship. If our cash flow is equal to our profits, then it'll take us 4 years to get our money back. And we're getting a return of 25% per year. What's 25% times 4? It's 100%, right? So we get 100% of our money back. Now, again, this does not factor in the time value of money. It's not a very sophisticated approach. We wouldn't share this with investors. It's just a quick and dirty way to say, does this project even make sense? Right? Is it even in the ballpark? Questions or comments? Okay, well, now let's get into the time value of money. This is where it gets interesting, I think. Time value of money. As it says here, $1 today can be used now to earn more money in the future. Going back to that earlier question I had, would you prefer $100 today or $200 next year? Well, it depends. You need more information, right? You need to know how much you can invest that $100 for, so that you know how much it would grow to over a year. And how certain are you that you would get that $200 next year? So inflation is a consideration. If you're not growing your money, you're not investing it, you're probably losing purchasing power. Because we tend to always have some inflation, right? In typical times, it's somewhere around 2 or 3%. You know, it's not that painful, not that noticeable. Obviously, after the pandemic, it was really bad, right? Because there were supply issues and there were demand issues. A lot of demand, not a lot of supply. And that really pushed up prices. And plus you had a lot of companies just price gouging. Things have settled down. It might not feel like it, but the rate of inflation has gone back to something normal. Fortunately, when costs jumped up, they didn't go back down, right? So they're not going up as quickly, but they also did not go down for the most part. But it is a consideration. If you just sat on your money and did not invest it, you'd be losing purchasing power because there's inflation. So that's one reason that you do want to factor in the time value of money. But the most important reason, as I mentioned earlier, is that if you invest your money and you do it wisely, that money is going to grow probably at a rate faster than inflation, right? So the sooner you get your money, the more time you have to invest it. So that's a consideration. All right. So again, what we're going to be doing is figuring out what is the present value and what is the future value. In that situation where I said, what if I were to give you $200 next year versus 100 today? How would you compare those options mathematically? If you knew what interest rate you could get, you could either take that future value and say, well, what would that be worth in today's dollars? If I could invest it today to grow to 200. But you could also take that current $100 that I said I would give you, hypothetically, and you could say, what would be the future value of that money? So we use this time value of money approach to bring future values back to today, or today's values to the future. And that way we can compare them with each other. All right, again, we can do that with lump sums and we can do it with annuities. Let's start with lump sums. Again, a lump sum just means you're putting money in one time, not multiple times. So if we deposit $100 in the bank today and it earns 5% interest per year, simple interest, not even getting into compounding right now. We'll get there. Then that would grow to $125 after 5 years. So the present value is $100. The future value would be $125 because of the interest. With an annuity, we're putting money in on a regular basis, or like I said, in some cases, we're taking money out on a regular basis. But in this case, we're putting it in at the end of each year for 5 years. So we take $100 at the end of each year, put it in the bank for 5 years. What's that going to be worth at the end of that period? It depends on the interest rate, right? Depends how much interest we're getting. Do they give us an interest rate here? No. Okay. But they must have had some interest rate to calculate that $500 that we're putting in, right? $100 times 5 deposits. We're putting in 500, but it's growing to $780 over that 5-year period because of the interest. How would you calculate that? It's pretty complicated. Because you'd have to take the first deposit of $100 and figure out how much that's going to grow, and the second deposit and figure out how much that's going to grow, right? Because they're happening at different points in time. Fortunately, we've got easier ways to do it that I'll show you in a little bit. But let's just go ahead and take it on faith here that $500 investment grows to $780. It says, though, the present value of that $500 investment is $460. Why would that be? Why would the present value be less than we're putting in?
The inflation.
What's that? Inflation? Well, it does have to do with interest rates, because if we're putting in $100 at the end of this year, that's already a future value, right? What if we asked ourselves, how much money would we have to deposit today so that it would grow to $100 by the end of the year? That would be something less than 100. Assuming we could get some sort of interest, we would deposit less than 100 today to have 100 at the end of the year. And we're talking about 5 future deposits. So we're having to discount all 5 of those deposits back to today. You could do it manually, but again, there are some easier ways. There's a table. Actually, there are 4 tables at the end of the textbook I'm going to show you that we can use to make this a lot simpler. And then there are spreadsheets as well. Oh, here's an example, one of these. Is this a table? Let me see, what is this? Oh, no, this is just simple interest. Okay. So in this case, we are investing $10,000 a year for 4 years. Trying to figure out how much interest are we going to earn here. So in the first year, we invest $10,000 at the beginning. In this case, we're doing it at the beginning of the year. And we're getting 10% interest, which would be great. You can't get that at the bank today. But that means that our $10,000 investment in 1 year grows to 11,000, right? And how would we do this on a calculator? First, we open the calculator. You could say $10,000 times what?
Is it 0.10? Is it 1?
0.1? 1.1. Let's multiply by 1.1. And then we'll see what our money grows to by the end of that first year, right? Because we still have the 10,000. So we're not trying to decide just how much interest. If we wanted to do that, we would do 0.1. But if we do 10,000 times 1.1, that shows us what our investment's going to grow to. So in 1 year, it grows from 10,000 to 11,000, right? And then we could simply on the calculator just hit enter again. It's going to multiply it by another. Well, if it were compounding, we would do that. But I forgot, it's not compounding. It's simple interest. No, it is compounding. Okay. Look before you talk. Okay, so since it's compounding, I can just hit enter again. And we see it grows by another 10%. So now we're getting interest on our previous interest. So we're not getting just $1,000 a year. We're getting 10% of whatever our prior balance was. And then I could hit enter again and enter again. So when the interest is compounding like that, when you are earning interest on your interest, you could use that approach. Your original investment times 1 point the interest rate. And then just keep hitting enter and it'll keep compounding. And you see, you know, we made $1,000 in year 1, but we made $1,000 in year 1. We made $1,100 in year 2. 1,210 in year 3. So we keep earning more interest. This is how rich people do it. They get their money to make money for them, right? Through compounding interest. Not yet. Right?
Can you add your initial investment to?
Yeah.
Okay.
Yeah. I mean, there are some investments where you can't, but in most investments, yeah, they'll be glad to take more of your money. And then, yeah, now your principal is increasing and your interest is increasing, right? So yeah, you could do that. But then the calculations get more complicated in that case. If you're putting in a set amount on regular periods, then that's an annuity, right? We'll talk more about those. So here we see compounding interest, and we see that off of that $10,000 investment in 4 years, we earned $4,641. Basically a 46% return over those 4-year periods. Okay, but that's, you know, that's just a fairly simple calculation. And we see, you know, if our present value is $10,000, that's what we're investing. The future value is $14,641. Here's an example of one of those tables I told you about. So let's say you are going to invest a lump sum of money and you're saving up for vacation. You want to take a vacation in 6 years. That's a long time to wait, right? Too long. This is a big one. This is a big vacation. This is Fiji or something. And you're going to invest $4,500 just one time, right? That's what makes it a lump sum. It's just one amount of money that you're investing. And somehow you're able to get an 8% return, which again, you know, you're not going to get in the bank today. But for the sake of argument, let's just pretend that you could. You could go to this table. Again, you'll find them in the textbook at the very end of one of the appendices. It's called the time value of money appendix. There are 4 tables there. One of the tables is the future value of $1. Now you're investing $4,500. but this table is based on the dollar. So what you're going to do is get the result from this table and then just multiply by 4,500. So what you're going to do, because you know you can get an 8% return and you're going to wait 6 years to take your vacation, you go to the future value of a dollar table. You go to the 8% column because that's the return you're expecting. You go to 6 years because that's the number of periods you're willing to wait. And you see you get this number, right? 1.587. That's the factor at which your investment is going to grow. Then you take your investment, $4,500, and you multiply it by that 1.587. That tells you what the future value of your investment is going to be. Pretty simple. Comes out to $7,141.50. Is that enough to get you to Fiji and back? Yeah, is it? Okay. Oh, or at least there. Who cares about coming back? So this table makes it a lot simpler. Just find the right column based on the interest rate. Find the right row based on how many periods you're going to wait. That gives you your factor. Multiply it by your investment. You got your answer. You know the future value of that investment. Any questions on how to use this table? All right. Perfect. Okay, what if you're putting money in on a regular basis, right? Yes, you're putting in $10,000 a year for 15 years. So this qualifies as an annuity because it's happening on a regular basis. You're either putting money in or taking money out on a regular basis. In this case, we're putting money in. At a particular interest rate, 8%. So we have a different table for that. We're now trying to figure out what is the future value going to be of this investment, but the investment's an annuity. So we go to the future value of an annuity table. We go to our 8% column. We're planning on investing for 15 years. Oops, no, I guess it's 12%, sorry. Here it says 8%. Okay, it's 12%. That must be a typo, but it says 8% here. Okay, so we're going with 12%. So we would, if we can get 12% interest, that's amazing on a regular basis. We go to the 12% column, all the way down to 15 years, and we have a factor of 37.280. We multiply that by our annual investment amount. Not the total that we're investing, right? Because we're really investing 150,000 over that 15 years. But we just multiply that factor by our annual investment amount of 10,000. And that gives us 372,800. So we've invested 150,000 and grown that. We've more than doubled it, right? The 372,000. So that's why the sooner you start investing, if they are safe investments and you're getting a decent return, you know, the more time you're giving it to cook, you grow your money. So this is how you use the future value of an annuity table. Very similar to future value of a dollar. Right? Find the column, find the row, multiply by your annual contribution, and you got your future value. Questions or comments? Right. Oh, good. Okay, now you get to practice. You're saving for a car, you put away $5,000. You want to know what's going to be the future value in 7 years at 5%. Which table would you use? Future value of a dollar or future value of an annuity? Dollar? Yes, because it's one lump sum investment, right? You're just investing one time. You can call that a dollar, you can call it a lump sum. On the other hand, if you're investing 11,500 per year for 14 years because it's a regular thing, now this is an annuity, right? And if you're trying to figure out what the future value is going to be, it would be the future value of an annuity table. So let's see, let me show you where these tables are in the textbook. All right, so if you go to our text, oh, darn it. Okay. Like I said, I was having technical issues today, and so I have to go there a different way. All right, so let's just say we're in chapter 11. We can go to readings, and this will take us to the textbook. Okay. So once we get to the textbook, you want to scroll all the way down to the bottom of the table of contents and see how Appendix B here is time value of money, right? That's what we need. Okay, now in this appendix, we've got 4 tables. Present value, we didn't get to present value yet, right? So we'll get there. But present value of a dollar, present value of an annuity, future value of a dollar, and future value of an annuity. Those are the 4 tables. So for this first question here it is. We said this was a lump sum investment of 5,000, right? So we want to know in 7 years at 5% interest, what is that going to grow to? Make sure we're on the right table. Future value of a dollar. It was 5%. We go down to 7 years. So we take 1.407. What do we do with that? Okay. We multiply that by the $5,000 investment. And there's our answer. Pretty easy, right? And the second one, we're investing this amount over 14 years at 8%. Again, this is an annual investment. So we use future value of an annuity. It was 14 years, 8%, right? So we go in the 8% column, go down to 14 years, 24.215. What do we multiply that by? Yeah, it's the annual 11,500, right, that we're putting in every year. So multiply that by 11,500, and there's our future value. Okay, any questions on these tables? All right, let's see what's next. Present value. Okay. Present value is sort of the same thing. It's just we're taking the future value and trying to bring it back to today's amount. So you might have picked up that with those future value tables, the answer we get is always something greater than 1. With the present value tables, because we're taking a future amount and discounting it back to today, it's always going to be something smaller than 1. Because again, what we're trying to figure out is how much would we need to invest today at a certain interest rate to grow to that future value. All right, so whatever that future value is, the amount we have to invest is going to be something less. All right, so here we're saving for college. We're going to put in, we want $40,000 10 years from now. So how much do we need to invest today at this 3% interest rate to have $40,000 in 10 years? So we go to the present value of a dollar table. Why are we using the present value of a dollar instead of annuity? Because it's a one-time investment. That's right. Okay, so we go to this present value of $1 table. We're expecting a 3% interest rate. Nothing to be too excited about, but hey, it's better than nothing, right? At least it kind of keeps us up with inflation. And it's for 10 years. So we go to the 3% column, go down to 10 years. Our factor is 0.744. Actually, this one kind of cuts it off. It should actually be 0.7447 if you had a better table, but that's okay, close enough. In this chapter, there's a lot of opportunity for rounding issues. So I've built in buffers in the exercise set and the problem set. If you ever get marked down because of a rounding error, I don't think it's going to happen, but if it does, bring it to my attention. I'll give you the credit for the answer, and then I'll fix it so it doesn't mark other people down. So here we see, obviously, you get a difference between 0.744 and 0.7447, right? That's going to throw off your answer. But the buffer should take care of it. So we take that 0.744, multiply it by the future value to figure out now what our present value is, how much we would have to invest today. So basically, if we invest a little under $30,000 today at 3% interest, it'll grow to $40,000 in 10 years. Okay. Let's say we're going to be investing money every year. Then it's an annuity, right? So we need the present value of an annuity table. Same concept. We need to know our interest rate. In this case, it's a 5% interest rate. We need to know the number of years. In this case, it's 5. We get our factor. We multiply it by our annual investment. And that tells us, no, I'm sorry. I said that backwards. In this case, we're getting $1,200 a year. Hold on. In this case, we want to know how much can we get today from the bank if we're going to pay them back $1,200 a year. So sorry, I botched that up, but that's what this one is about. So it is an annuity because we're paying back $1,200 per year, and we're trying to figure out the present value. How much is the bank going to lend us today if we're willing to pay them back that much? So this figure that it gives us is how much we'd be able to get from the bank today. Now, if we're paying $1,200 a year for 5 years, how much are we actually paying? Yeah, $6,000. $1,200 a year times 5 years, we're paying $6,000. So we're borrowing from the bank about $5,300 and paying back $6,000. Why do we have to pay back more? Interest, right? So this tells us how much we could borrow based on how much we're willing to pay back. But it's the same idea, right? You got your column for your interest rate. You've got your row for the number of periods. Okay, so go ahead and see if you could solve these two using those tables. If you have a phone, you should be able to access the textbook. Either through Canvas, or if you have the OpenStax app, you can go directly to the textbook. Oops. So in the first case, you're saving for college. You want $100,000 in 12 years. And you can get 5% interest. Is this lump sum or is this an annuity? Doesn't really say, does it? So I believe this first one is a lump sum. So how much would you need to invest today to have 100,000 in 12 years? So let's start with that one. Which table would that be? Present value, because we know the future value that we want is 100,000, right? So we're trying to figure out how much we invest today. We're trying to figure out the present value. And because it's a lump sum, it would be present value of $1.
5 years.
5 years, 12%?
12 years, 5%.
12 years, 5%. Okay. So go to the 5% column. 12 years, our factor is 0.557. What do we multiply that by?
Yeah, 100,000.
The $100,000 future value. So we'd invest about $56,000 today, and it would grow to $100,000. Now, the next one says you need to borrow money for college. You can afford to pay $1,000 per year. That makes it an annuity, right? For 8 years, and the rate is 3%. You're trying to figure out how much money you could borrow. So what table would it be? We know how much we're going to pay, right? Annuity. And we're trying to figure out the present value, how much we could borrow today. So present value of an annuity, it's 8 years, it's 3%. Go to present value of an annuity, 3%. 8 years, we have this factor of 7.02. And what do we do with that? Wait. Did I look at the right one? Present value of an annuity. Yeah, that's right, 7.00. What did you say, Jahara? Yes, we multiply by the $1,000 annuity amount. So 1,000 times 7.02. So the bank will lend us $7,020. That's the present value, right? That's what we'll get today. We're going to be paying them $1,000 a year for 8 years. So we're paying back $8,000. Because they're a bank, right? They make a profit off of our interest. Okay, so any questions on anything we've covered so far? All right. Let me move back over there. So as I mentioned, when you take a future value and you bring it back to the present, you're discounting, right? It's always going to be then something smaller. Because the idea is you could always invest your money now and grow it to something bigger. So if we're going backwards, you're discounting, it's getting smaller. So we sometimes use this approach of discounting back to the present value to compare multiple options. Let's say you've got a project that's going to take 3 years and another project that's going to take 5 years. So there are different periods of time. How do you really compare financially these two investments over different periods of time? Well, if you discount them both back to present value, then you're comparing apples to apples, right? Or maybe your company has a certain net present value percentage that you require. So that if you discount it back to the present value, you've got a certain minimum percentage. And by doing that process of discounting back to the present value, you can then just compare and say, does this meet that requirement? Does it meet that minimum percentage? Or that expected rate of return? So this is called net present value. It involves discounting the cash flows of this option back to the present value, but then also factoring in the initial cost. If there's an upfront cost today, that's already in the present value, right? Let's say we have to invest $100,000 today. Today is the present. So that part, we already know the present value, but the future cash flow it's going to generate is what we have to discount. And once we discount it back to today's present value, we subtract that original investment. If we end up with something negative, something less than zero, we don't want to do it. So the project might look profitable, but when we do an NPV or net present value analysis, it then might not look profitable because we're factoring the time value of money. So we will go through net present value, and we will also learn IRR. Now, don't confuse IRR with ARR, right? Really hard to say. ARR was the accounting rate of return that you could do on the back of a napkin, pretty simple, right? IRR is the one, I don't even know how you do it. I just know you plug it into a spreadsheet and it does the calculation for you. So we'll get to that, but as it says here, you want to know technically how it works. Your IRR tells you what rate of return you're going to get based on having a net present value of 0. Technically, that's what it means. And then if a company sets a minimum IRR, then they would accept projects above that. They would screen out anything below that IRR. But let's do NPV first, net present value. Okay. We're already familiar with present value, right? We already did some exercises with present value, taking a future value, discounting it back to the present. We've done that with annuities. We've done it with lump sums. So really, this is not too different. In this case, we've got an investment of $200,000 up front. We've got annual cash flows of $40,000. And so we're trying to now discount those cash flows to the present value. Once we do that, we subtract the original cost, the upfront investment, and we get our net present value. Net meaning discounted cash flows minus the upfront cost gives us the net present value. And again, if it's positive, it's an acceptable option. Doesn't mean we should do it, it just means we could do it. And this one came out positive, right? If it's anything under 0, you don't do it. So the first part is pretty easy because again, our initial investment is already in the present, right? However, the cash flows are over a 10-year period. If it's $40,000 a year for 10 years, well, then we need to go to our present value of an annuity table, right? To take those 10 years of cash flows and figure out what's the present value. So you see it here, present value of an annuity. We go to our 8% because that is our minimum rate that our company requires. We're not going to do a project unless it's giving us at least an 8% return. So we're using the 8% column. And again, it's 10 years of cash flow. So that gives us a 6.710 factor. Multiply that by our annual cash flow of 40,000. That's where this figure comes from. Subtract the original investment. That's our net present value. Okay, it's not that difficult. Are there any questions on net present value? All right. What if you've got multiple projects with similar net present values? How do you then compare them? I mean, you could compare other factors, but is there something else mathematical we could do that would help us see which is a better option? Or what if you've got a very large project and a very small project that both have similar net present values? Or how would you even compare them when they're so different? So one thing you can do, take the present value of the cash flows, divide it by your initial investment. That's going to give you a different way to look at your answer. As it says here, that's going to generate a profitability index. In other words, for every dollar invested, how much profit are you going to generate? This is a different calculation using the same numbers. Here we've got two different options, A and B. By following this formula, present value of the cash flows divided by the initial investment. For option A, we got $1.34 profit for every dollar invested. Whereas for option B, we got only $1.21. So this would help us say, hey, option A looks better, right? So if you have similar net present values, or you're trying to compare a really big investment with a really small investment, using this approach can help you see how much more profitable one investment might be over the other. Okay, so that is your profitability index calculation. Any questions? Okay, and then, what if our cash flow is not even? Remember, we experienced that with the payback period, right? A little more work in that case. If it is even, like we saw here, if you know it's going to be $40,000 of cash flow every year, you can use the present value of an annuity table. But if it's not an even amount, if it's changing every year, if your cash flow projections look like this, then what do you do? You can't use the annuity table because it's not a regular amount every year. And it's not a lump sum, right? What do you do? That's my job, right? Not you.
Would you average it out or?
You probably could do that, but there's an easier way. Because you could average it out, but then what do you multiply it by? It would get complicated. What you would do, you would use the lump sum of a dollar table. No, present value of a dollar table. You have a lump in my head. You would use the present value of a dollar table. And on that table, you would go to whatever your interest rate is here, where it says I, that stands for interest. So we're basing it on an 8% interest rate. That's what the company is requiring. And then you would look on that present value of a dollar table, you would look in the 8% column, and you would take every single year. Year one has a rate of 0.926. Year two has a rate of 0.857. You would just have to take the factor from every year, multiply them individually by the cash flow amount, and then add them up. It's time consuming. Again, if you use a spreadsheet, it could do a little easier. What'd you say?
You said it was easier.
It's easier than if you tried to average it, then what would you multiply it by? I don't know. My brain can't figure that out. I don't know. But if you use spreadsheets, they could help you here too. The spreadsheet, well, actually, there's a net present value function in spreadsheets that makes it super easy. Where you just plug in the numbers and tell it you want the net present value based on a certain percentage, and it gives you the answer. Hey, you need AI to do the spreadsheet for you?
That was the question.
To just take the class for you, maybe? All
I
right.
see that 1 and 3 are both 20,000, but they both have different like present value factors.
Yes.
Is that just
Because
of the year?
this is what the company is expecting its cash flow to be every year. This is from the table. And so from the table, in fact, let's look at it. This is the present value of a dollar table. And it's the 8% column. So let's look at that. Present value of a dollar 8% column. It's just taking these numbers, which get smaller year by year. And so normally we would just use one of these because it's one lump sum, right? But in this case, because it's year after year at different amounts, we're taking each year's present value as its own factor times that year's cash flow, right? We're just doing it year by year.
So even though the lump sum's the same, like that.
Yeah. Yeah, exactly. So the amount of cash flow is completely not related to the present value factor. But you are going to multiply them to get the present value amount, right? And then you'll add them all up, subtract your initial cost, and get your net present value. So I'll show you later how to do this in Excel or spreadsheets, make it easier. And even if, I mean, again, there is a net present value function in Excel that makes it super easy. But another thing you could do, if you already knew the cash flow amounts and you already had this information, you could also have Excel just multiply for you, right? And then add them up. So there are all kinds of ways you can use spreadsheets to make your calculations easier. So any other questions on this slide? Okay. Oh, here's an exercise. So we have, let's see, $20,000 annual savings. So that's a set amount. Yep, you can treat it like an annuity for 10 years. We are going to sell this bubble packaging machine in 10 years for $50,000. What is the present value, assuming a 9% interest rate? All right, let me open up the exercise set. Yeah, it's an exercise. Let me open up the exercise set. Let's look at exercise 13 together and think, how would we solve this? Okay. So we're considering buying this new bubble machine, right? And we see the cost. Actually, does it show us the cost? I don't think it even tells us the cost. So we're not going to factor that in. But we are going to look at the fact that it's going to save us $20,000 a year. So that's basically net cash flow, right? Even though it's not bringing more money in, it's saving us $20,000 per year. So it's because we have less cost, it's increasing our cash. For 10 years. And then we think we can sell this machine after 10 years for $50,000. And we are using a 9% interest rate. So we have to calculate these things differently, right? We have the annual cash flow over 10 years. That'll be one calculation. We have the $50,000 that we're going to get in 10 years. That's a lump sum that we have to then discount back to today. So we're discounting the cash flows to today. We're discounting the $50,000 from the sale of the equipment to today. And that will, if we combine those two together, then that'll give us the total present value of that machine. Again, we're not factoring in the cost of the machine in this case. So which table would we use for this first calculation?
Present value.
That's exactly right. And which one would we use for the second calculation?
Value of a dollar.
Present value of a dollar. Correct. Okay, so go ahead and figure that out. Feel free to work together.
I think they don't have a 9%. They go by.
Oh, good point. There's no 9%. Okay, we have options. There is, yeah, in the textbook, I don't know why, they came up with this exercise and they didn't give you a table that has 9%. In the problem set, I have a link to a table that does have 9%. So let's see.
We just do like 1 divided by 1 plus the interest times a year.
I don't think it's gonna, maybe you could try it and
I
see.
tried it.
Did you get the right answer though?
Wait, let me see what was
I didn't show the answer yet, so let's,
percentage of it.
10 years and 9%. Okay, so problem number 11 in the problem set does have a link to,
422.
okay, that might be right. Did it open? Try that again. Okay, so here's a present value of $1 table that, oh, that doesn't have 9% either. Okay. Well, then I'll tell you what, let's do it with a spreadsheet. We'll just do it that way. And then we'll see if your answer came out right. So I'll start with Excel. Later on, I'll show you Google Sheets. Okay, so just open up Excel, just open up a blank worksheet. And in fact, what I'm going to do here for reference, I'm just going to see. I'm just going to copy this whole thing here. Do like this. Just so we don't have to go back and forth. Ooh, that did not look pretty. Okay, that's all right. Okay, that's better. So present value of an annuity for $20,000 at 9% for 10 periods. So let me show you how we could solve this in Excel pretty easily, actually. Up here, this fx right here, see how it says insert function? If I click on that, then it's got all kinds of different formulas that it can calculate for me. Right now, we're trying to figure out present value, right? So I could just type PV for present value. And there it is. There's my PV function. I can go ahead and double click to select it. And it gives me this. What's this? Well, it asks me for the rate. Over here, it says our rate is 9%, right? 0.09. Then it's got NPER. Anybody know what that represents? Good guess. But no. Number of periods. Number of periods. Number of periods. Well, it says here 10 periods, right? So we put that in. Then it's got payment, PMT. Payment is used for annuities. It's the annual amount. And here we see the annual amount is $20,000, right? Now you have to enter it as a negative number because it's money you are spending, right? So negative $20,000. That's our annual amount. If it were a lump sum we were dealing with, we would skip the payment part and we would put the lump sum as a negative number under future value. But we're not trying to figure out how much a future value is worth today. We're trying to figure out how much that annuity is worth today. So you always pick either one or the other, but not both. And then it actually previews our answer for us right here. So I can click OK. And that tells us the present value of that $20,000 that we're paying, no, getting that $20,000, actually it's $20,000 of cash flow savings, right? That we're getting every year for 10 years. That's worth 128,353 in present value dollars. Well, we're going to do it again for this one, because here we're trying to figure out the present value of $50,000, but that's a lump sum, right? And again, it's at 9%, and we're not going to get that money for 10 years, 10 periods. So we do the same thing.
You can also like equals PV.
That's true. Yeah. And so I hit function. It remembers that I like PV because I just searched for it. So it came up and I can just go ahead and select it. And then again, put in the rate of 9%. Put in the number of periods, 10. This case, because it's lump sum, we're going to skip payment and we're going to put the amount under future value because that's what we know. We know it's going to be worth 50,000 in the future. So that's the future value. And again, I'm going to put it as a negative number. Hit OK. So that $50,000 10 years from now is worth basically $21,000 today. So this machine is going to give us a present value from the increased cash flow of that amount, plus a present value from selling the machine in 10 years of this amount. We could then add them together. So in Excel, you could do fun things like if I just type equals, I could click on this box plus this one, enter. Adds them together for me, nice and easy. And there's our answer. We just add them together, we get 149,473.69. Again, so there might be a rounding error, but let's see how close we are. Okay, so the textbook calls it 149,474. Ours is actually a more accurate answer because they rounded off to the dollar. But again, it shouldn't matter when you put the answer in Canvas. Either way, it should be marked as correct. Now, did that work out, Joe, with what you had calculated? Yeah, there might be other ways to do it, but if you've got the right percentage on a table, you can use that. Right? We didn't have a 9%, so that, you know, we could find a table with 9% and do it that way. But really, once you get used to the spreadsheets, they're a lot easier than using the table. So,
What you know about spreadsheets?
Alexandra brought up a point. In Microsoft products, they usually give you multiple ways to do the same thing. So what he pointed out was instead of going up here and clicking on the function button and searching for the function, if you know that the function is called PV, you could just start typing equals PV and it already knows what you want. Now we have a couple minutes before the break. I want to show you the same solution, but in this case, we're going to use Sheets. So if you just go to Google Sheets, and you might need to sign in with your login. Just let me use this sign in link. Okay, so you might need to sign in. I'm already signed into Google. But if I weren't, I would just sign in with any Google account. And it looks a lot like Excel, right? And if we're trying to solve the same thing, make it a little bigger. Okay. All right, so first we wanted the present value of an annuity. In Sheets, it's definitely recommended that you use Alexandro's shortcut, because if you go insert function, you then have to go to financial, and then you have to find your function. It's kind of a pain. If you know you're looking for present value, you could just go equals PV. And then it says tab to accept it. So it thinks we want present value. So we can just click tab to confirm that that's what we're doing. And then it prompts us for what information it needs. First, it's asking for rate. So I put in 0.09, the 9% rate. And then you have to remember this or make a note. You put a comma. Then it prompts you for the next field, number of periods. Okay, we know it's 10 periods. Again, we put a comma. Payment amount. Now remember I said payment is for annuities. And this first one is an annuity. So I'm going to put negative $20,000. When I put that in, 20,000 has a comma in there, right? But don't put the comma because then it thinks you're going on to the next field. So just skip the comma. So I just put negative 20,000 without a comma, and I'm actually done. That's all the information I need. So I can just hit enter. For the next one, again, equals PV. Tab to accept it. The rate again was 9%. Comma, number of periods was 10. Comma. Now this time, we are expecting a $50,000 lump sum, right? So there is no annuity in this case. So we're going to skip payment. The way we skip payment is we just type another comma, and it just skips that field. And then we put the minus 50,000 because that is the future value that we're trying to discount. And then we hit enter. And now one neat thing about Google Sheets is it guesses at what you're trying to do. Right now, I don't know what it's thinking we're trying to do here, but that's not what we're trying to do. So I'm not going to accept that suggestion. I'm going to reject it. If I were to type equals sum, and then I can just select these two. Did that work? Yeah. Okay, I did it wrong. Let's try it again. Equals sum. I have to tab first. Okay, and there we go. It totaled it up for us. So once you get used to it, it's actually pretty easy to use. It's just, those first couple steps. All right, so we are at break time. Why don't you go ahead and take 10 minutes? I'll see you at 2:50.